Hey everyone, welcome to question 2 of the FIN117 main exam. So in this question, let's have a quick read through. So I've got a customer who's in the business of supplying contracts, and we've been provided by their accountant a draft statement, so draft doesn't mean it's final, statement of profit and loss for the year ended 31 March, as shown below. Okay, so we've got the draft in there. So you can already anticipate that we're going to be expected to make some sort of change or additions to this P&L already because it's in draft, or review it. In addition to the statement of profit and loss, there are a number of issues that are... Okay, let's just skip to the end and read the question. Okay, so prepare the statement presenting the comprehensive income for CLIMA for the year ended. The statement of profit and loss is not required in response, but ensure you show all workings. Ignore the impact that issues 1 to 5 may have on current or deferred income tax. Comparative notes are not required. Okay, so it's fairly straightforward. It's all in one question. It's a 20-mark question. What we have to do is we have to prepare the comprehensive income. So I know what we have to do. They've given us the P&L, but they haven't given us the profit and loss and other comprehensive income. Well, they haven't given us the comprehensive income part of the P&L and other comprehensive income. So if we go back to the P&L, if we go back to the CSG for chapter 2, which is about presentation of financial statements, you'll know that one of the main reports is this, the statement of profit and loss and other comprehensive income. So whenever you're looking at that, you've got your profit and loss up the top, which most people are familiar with, but you've also got the other comprehensive income down the bottom. And that's the stuff that's to do with, like revaluations. It's to do with, translations, change in fair value, that kind of stuff. That doesn't necessarily hit the top line P&L, which is your, organic quality earnings, which people consider this is what the underlying business is generating. This is more to do with one-off or non-cash revenue and things like that. So just a quick recap from the CSG. So up the top here, we've got your typical P&L at the top, all the way down to profit before tax. Then you get profit for the year before continuing operations. Then you've got discontinued operations in there, if that's applicable. And then you've got profit for the period attributable to, and then you split it up between owners of the entity and non-controlling interest. So that's when we talk about consolidation later on in the chapter. So if you own, say, if you own 60% of an entity, what you do is you report 100% of the profit all the way down to profit, and then you take out that minority interest there, the non-controlling interest in this line item there, rather than split it up in the top of the P&L. Then you get to this bit, the other comprehensive income. So that's the stuff that I mentioned before is, more to do with one-off or non-cash earnings, fair values and adjustments and things like that. So this is what we need to provide in the question. We need to provide from about here, profit for the year. That's when the P&L above ends. And this is where the other OCI starts. So we probably need to start off with profit and loss, and then we're going to have all our other comprehensive income adjustments. And then we're going to have this total line down here, which is our total comprehensive income for the period. Okay, so what I would recommend doing to approach the question is, first of all, in your exam, have your notes open, your CSG notes open in this critical file. So you can basically just have this as your template, which you can just copy. And next, what I would recommend is actually setting up a template. It's basically just what's on that page over there. I've already done it over here. What I've done is I've just shown, you can see we've got profit up the top, which we'll take from the question. Then we'll go to other comprehensive income, which is kind of like your subcategories. And then within there, you've got your subcategories of other comprehensive income. So you've got up here, see this bolded text here, over here. So items that will not be classified to profit and loss. So I'm just going to put in some examples here, and we can delete it out when we read the question. Revaluation of land and buildings, income tax on items that will not be reclassified. I'm not saying we need these necessarily. I'm just putting it in there for the time being. Okay, cool. And then what we're going to do is I'm going to sum up both of those, and we get the values for them. And then underneath, you've got the subcategory of items that may be reclassified subsequently to P&L. So we've got foreign currency translation, fair value through other comprehensive income investments, change in fair value, cash flow hedging, change in fair value. We've also got this, we've got share of OCI from associates accounted for using equity method. That's basically when you own a non-controlling stake in a business, like you might own 20% or something in a company, and that's when you just, when you consolidate it, you don't include it in your P&L as a 100% item, you just include it as the one line share from investment or profit from investment. This is where you actually include that one line from that investment's other comprehensive income. What else? Income tax impact. That will be reclassified. And then you get the total, and you just sum up those. Okay, and then that's basically how we get to our other comprehensive income, which is the sum of those, two. And our total comprehensive income is going to be the sum of our profit plus our other comprehensive income. So that's the end goal that we want to get to. Now let's actually read the question, pull out the information, and see what we have to do. Okay, so we're back on the original question. So the first thing that we need to complete this other comprehensive income is obviously the profit figure up here. Okay? But, this is a 20-mark question. That involves a lot of work. So clearly it's not just going to be as simple as plugging in this draft profit number, putting in 1, 2, 3, 4, 5, or however so many. That clearly doesn't add up to 20 marks. So it's going to be a little bit harder than that, obviously. You can tell that just by the number of marks they're allocating. So for the profit, the first thing that we obviously have to get some marks from is what is that actual profit figure. Because I mentioned before when we read this, that these are all draft numbers. They're not finished. That means we may need to review it. We may need to add some adjustments depending on the extra information given to us in the question. So what I propose we do is, as we go through each single one, we start putting our working down and saying the impact from that's going to be from the P&L, the impact from that's going to be other comprehensive income, and so forth. So let's have a look at the first one. So the first background information is the contract with New Zealand customer of 350k was recognised as a trade receivable on 15th of February 2017 based on the spot rate at that date. The trade receivable was still outstanding at March 2017 and remains recorded at the spot rate. The Australian dollar has not been adjusted. Okay, so the first thing to note is that trade receivables, if you remember from your CSG, trade receivables are actually deemed a monetary item. So they're a cash or cash equivalent, which can be converted to currency. So monetary items, according to this chapter, foreign exchange, needs to be converted to the spot rate at the end of the financial year. So here it is here. Foreign currency, monetary items, translation method. Use the closing rate, the spot exchange rate at the end of the reporting period. That's IAS 21. So what we're going to have to do is we're going to have to convert this monetary item, because this customer has a year end of March 2017. We're going to have to convert the value of that at 0.9 exchange rate. Any difference is going to hit the P&L. Okay, so what I've done over here is I've just set up this draft table over here. So see how I'm kind of, I'm logically thinking through the process. I'm saying this is the end goal. This is the adjustments that I need to do. I don't know what those adjustments are yet, but this is the structure that I need to do in the exam. And then the step after that is I'm going to go through each adjustment. So first of all, adjustment 1, we're then going to go and set out our workings underneath like that. So that really neat logical process is going to help you works for the question a lot better. It's going to set out your workings in a logical manner that's easier for the marker to mark and give marks where they might not do it otherwise. So it's just a really helpful approach to take. So adjustment number 1 is this FX. So you can even put a title on it over here. And you might want to do some description language up the top. So for example, trade receivables is a monetary item, needs to be converted at spot rate at end of financial year. Something like that. But if you don't have time in the exam, and you can just do the workings, and that should be fine. But the perfect response will have a description. It's going to have good workings. It's going to have titles, dollar amounts, everything like that. Okay, so the what they purchased it for was because the functional currency is in Australian dollars, we need to convert it to, see, functional currency is Australian dollars, we need to convert it from New Zealand dollars to Australian dollars. So the original recognition that they would have done is 350,000 times 0.96. So we can say initial recognition, excuse my spelling, and then end of financial year recognition is equal to 350 times 0.98. So P&L impact is effectively going to be the difference between those two, and this is going to be a gain, because if you think about it, the journal is going to be debit trade receivables because we're increasing our asset 7,000, and the other side is going to be a credit, and that's going to be in the P&L. Therefore, it's going to be revenue. So it's going to be revenue. Okay, so moving on to adjustment number 2. Okay, let's read the background information. So there's an outbreak of a disease in Perth, and the cause was traced back to a contaminated air conditioning system in a building which Klima maintains. It's probable that Klima will be held liable for $5 million in damages which will not be covered by insurance, as the damages will be due to negligence. The financial statements are expected to be authorized for issue on 1st of May 2017. So they were aware of it in April. So they were aware of it before it was issued. So the question is, how do we actually account for this? So if we go back to our CSG, this is obviously to do with adjusting and non-adjusting events, which is still in Chapter 2 for financial reports. Basically, an adjusting event or a non-adjusting event depends on whether or not it occurred after this reporting date, but it existed before. Now, if it existed before reporting date, as was the case here, then it is an adjusting event, and it is something that we need to go and change in the P&L. So obviously, if there's going to be a $5 million legal suit, that means we're going to need to recognize a provision, damages, because it's probable, and that means there's going to be a $5 million impact, because the journal is going to be debit expense for the provision, and then credit provision liability. So it's going to be P&L expense. How much was it? 5 million. 2, 3, 3. Okay, so for part 3, it's a cash flow hedge question, or a hedging question in general, which I always find to be probably the hardest topic in all of FIN, simply because it's so difficult to understand what actually derivatives and financial instruments are. I find, having done the module, this is probably, out of all of the modules, this is probably the one thing that I probably still don't understand in entirety in the real world, especially, is how hedging instruments work. But I can show you the tricks so you can get the right answer down on the paper. You don't necessarily need to understand what it means, because it's so incredibly complicated. As long as you get the right answer on paper, you should be fine. So basically the approach for this is, number 1, figure out what type of hedge it is, because there's a few different types of hedges. Number 2 is pull up the exam Bible journals and use the appropriate journals, depending on whether it's a cash flow hedge or a fair value hedge, and so forth. And then write down the answer. So that's pretty much the approach I'm going to recommend for you. So let's read the question. So to hedge its floating rate loan liability, they've entered into a 5-year interest rate swap on April 2015. There was no initial cost into the swap. Designated the interest rate swap as the hedging instrument in a cash flow hedging instrument. So straight away we know it's a cash flow hedging instrument as opposed to a fair value. And I mean, you can read your FIN module to figure out what type of hedging instrument it is in case it doesn't say. Generally it will say in the question whether it's cash flow or fair value. But you'll see that cash flow is typically to hedge against variability in cash flows, whereas fair value is to do the same but against valuations and so forth. So we know it's a cash flow hedge. Okay, what else do we know? So we know that the hedge was correctly taken up to 31 March 2016, so that was last year according to the question, but no entries have been recognized for the period to 31 March 2017. So we need to record the entries for this year. So this is going to be another adjustment. So they've given us some values here. You're probably reading it and going, what the hell does that mean? That's fine. What I want you to do is bring up the exam Bible and go to the section on cash flow hedges. So you have to scroll all the way down to chapter 8, I think it is, and then scroll down even further past fair value hedges, because we know we're dealing with a cash flow hedge, until you get to a cash flow hedge down here. Most exam questions you'll get will be on a cash flow hedge. It's typically focused around that. Okay, so the journals that we need to follow is down here. It's typically the same portion approach in year 1 and year 2. Basically, on the debit side, you've got the change in the fair value of the asset. Okay, so we know that the fair value has gone up from 1.5 million from 13, so we know that that debit is 150,000. And on the credit side, it's saying the lessor of cumulative change in fair value of hedged item, that's 150 as we mentioned before, and the cumulative gain or loss on the hedging instrument. So that will be the underlying cash flows in this situation. So basically, choose the lower number, the difference between that number and that number, or the difference between that number and that number. So we've got 120 or we've got 150. So 120 is the lower number, so we're going to use that. So it's going to be 150 on the debit side, 120 on the credit side, and then this final bit, the loss or gain on the hedging instrument, which is the ineffective portion, that's the part that hits the P&L, is going to be the difference. It's either going to be a loss if it's a debit or gains if it's going to be on the credit side. Okay, so let's put that in our workings over here for adjustment 3. So we've got a okay, so the journals are going to be, I'm just going to write them down, FX forward, cash flow hedge reserve, effective portion, excuse my spelling, and then loss or gain on hedging instrument, ineffective portion, again, excuse my spelling. So it's going to be debit, credit, debit's going to be 150,000. That was the change in the fair value, and this one was the lower of the change in the underlying item and the change in the fair value. So we agree that that was 120, and we know that this is the difference between the two. It's going to be a credit, therefore it's going to be a gain. So I'm just going to remove the loss part. So we're going to go gain. So what we're going to do is we're going to go P&L. So this is what our P&L is going to do now. Our P&L is going to be a gain of revenue of 30,000. Okay, so for part 4, Klima's revaluing their land. They've used the revaluation model in IA 616 property, plant and equipment. They took up, in the previous, or 2 years ago, they took up a revaluation increment of $2.5 million. And then this year, at 31 March, the land has had a carrying amount of 11 million and a market value of 10 million. The lower market value was due to the downturn in the commercial property market. Okay, so if you think about what's happened in this question, so this is to do with the property, plant and equipment chapter, and we need to think about what's happened in the prior year, because depending on what happened, whether it's a decrement and now an increment, or an increment now a decrement, or no increment and now an increment, or no increment now a decrement. It's all going to result in different journal entries, which I'll show you in a second in the exam Bible, in the property, plant, and equipment. It really depends on the situation. So first of all, you need to identify what the correct situation is. Once you've done that, you can just then refer to the exam Bible and use the journals there. Super easy. So this is the only tricky part, is figuring out what actually happened last year. So we know in 2015 it took up a revaluation increment of 2.5 million, and then the land had a carrying amount of 11 million at 2017, and there was no other adjustment. So that means that in 2015, let's say they bought the property for 8.5 million. They then revalued it upwards 2.5 million to 11 million, and now they're bringing it down to 10 million. So what they're doing is they're reverse. So we have to bring it down to 10 million. So we need to reverse it 1 million, but that 1 million is lower than the entire increment that they put it up. So they increased at 2.5 million. We want to bring it down 1 million. So the 1 million is lower than the 2.5 million. That's basically what I'm saying there. So the situation we're looking for is that there is a previous increment. Here we go. Previous increment recognized, which was greater than the new decrement. So that's the situation right now that we're seeing. The previous decrement, 2.5 million, is lower than the current decrement of $1 million. So the journal that we're going to post is the revaluation surplus and then credit PP&E. So the credit PP&E, we're going 1 million, and then the revaluation surplus is going to be 1 million net of tax, but we're actually ignoring tax in this question because it specifically said that. Otherwise, it would be net of DTL. But for this question, it's going to be $1 million. And that's going to go straight to the other comprehensive income. Okay, so we need to make a note of that so we can pick that up. Let's put our journal in here now. So we're going to go debit reval surplus 1, 2, 3, 1, 2, 3, and then credit. Is it land? Yeah, it's land. What's the asset there? Or is it building? It's building. Building. Okay, so we're going to go OCI, reval. $1 million. Okay, I'm just coloring it a different color so we remember to pick that up in OCI and not the P&L. Okay, finally, let's have a look at question 5. So, Klima has a license to be the exclusive supplier of 5 key brands of air conditioner. The license is recognized as intangible assets, so straight away we know we're dealing with intangible assets. Due to loss of market share, it was impaired on 31 March 16, so last year. The 8-year license had cost $80,000 and was entered into 1 October 2014. It has been amortized on a straight line basis. An internal loss of $7,800 was recognized on 31 March, and the useful life remains unchanged. Due to the closure of 2 competing brands during the year, the conditions which gave rise to this impairment have resolved. The licenses were assessed to have a value and use of $58,000 and a fair value of $57,000, with estimated cost of disposal at $1,000 at 31 March 2017. The carrying value at 31 March 2017 is $48,400, which reflects amortization to the end of this year. Okay, so this isn't necessarily an intangible question. I misread that one. This is an impairment question. And the reason it's an impairment question is because it's asking us to compare, well, first of all, it talks about impairment loss over here, but it's also asking us to compare the cost of the asset versus the recoverable amount of the asset. And it's talking about value in use and fair value less cost of disposal. So those are all the terms when you see, you should immediately associate with an impairment question, because let's just recap what impairment means. So in your financial statements, you have various assets. You have tangible assets, intangible assets, etc. What you are required to do if you prepare general purpose financial statements or report under IFRS is you have to test your assets for impairment. So impairment's basically saying looking for an asset isn't worth as much as as you say it is on the balance sheet. So for example, it could be a business unit. You could be a company that owns childcare centers, and you have one company that owns childcare centers and one company that owns medical doctor centers. What you need to do on a regular basis, at least annually, is to look at a cash flow estimate of both of those businesses for the next 5 years, all the assumptions, etc. You sum up all of the cash flows for those business, and you also consider how much you could get for the business if you were to sell it, less the cost of disposal. And say, let's say for the childcare business, I could get $5 million a year, or I could sell the business for 15 times its worth and sell it for $10 million. But I've only got it on my balance sheet for, let's say I've got on my balance sheet for $8 million as the value of the investment. Now the investors might be saying, hold on a minute, you're telling me if I hold this asset in perpetuity, I can only get $5 million, but you've got the asset written as $8 million. So that's a misrepresentation of value. I don't care if you paid more for it, it's not worth that much. So the auditors are saying, okay, you actually need to bring that value of asset down. So it's all basically making sure that everything in the financial statements are always reflective at any given time of the current value of the assets that have been stated. So, we do fair value adjustments upwards for certain assets like land, property, equipment, etc. But we also need to assess for certain assets, if they're not worth as much as they are, so we're actually impairing them downwards. That's what impairments are. So this company's obviously bought, licenses, intangible licenses. They've paid $80,000 for them. The auditor is simply saying every year you need to make sure that they're actually worth $80,000 and that they haven't slipped down to, $60,000, $50,000. And if they have, you need to impair it down to that amount. Now, that doesn't mean, on any other given year, if we find that actually that was just a temporary blip and the asset is worth $80,000, we can actually reverse that impairment loss. And that might be what's happened here, because as you can see, there's an impairment loss of $7,800 recognized, but we may be able to reverse that. But there's certain rules depending on the situation, just like we talked about for the last one about carrying amounts. It really depends on the situation. How much was impaired last year? Can we impair that? Can we reverse that? And so forth. So the general approach for impairment is this. You need to ensure that the carrying amount, so in this case, the carrying amount for that asset, had no impairment being charged, less the recoverable amount is the impairment loss. So we need to make sure that the recoverable amount is at least greater to or equal to the carrying amount. Otherwise, we need to impair it. So the first step that we need to do is actually calculate the carrying amount. And the carrying amount as if no impairment charge had actually been lodged previously. So carrying amount. So how we calculate this is we bought the asset for $80,000 on October 2014, and it should be amortized on a straight line basis, okay? So its effective life is 8 years, so it should be amortized at $10,000 a year. So how long have we had it? We've had it from October 2014 to March 2016. So October is, how many months is that? Let's do a quick calc. 2016. Okay, so I've done the math. So then we're going from 1st of October 2014, actually we're going to go to 31st of March 2017 because we're looking at this financial year here. So the number of years is 2.5 years. Okay, so we know that the carrying amount is equal to 80,000 less 10,000 times 2.5. So the carrying amount is 55,000. Okay. The next thing to check is recoverable amount and let's just bring this up, recoverable amount, so sorry, fair value less cost of disposal, and fair value less cost of disposal, and value in use. So the fair value less cost of disposal is, per the question, is equal to $50,000, and the cost of disposal is $1,000, so it's going to be $56,000. The value in use is given us to in the question, it's $58,000, but typically in real life what you'd have to do is you have to do like a free cash flow forecast model and then sum up all of the future cash flows up to a certain point, and that would be the valuation. So that's how it works in real life. So what we know is that I have trouble with this terminology. So the recoverable amounts, these are the recoverable amounts here, are both higher than the carrying amount, which means there shouldn't be an impairment loss. Okay? So typically there wouldn't be an impairment loss. However, what we have to do is actually reverse out the impairment loss. So we need to reverse out impairment loss of 7,800. Okay, so we know that we have to reverse out the impairment loss because the asset's no longer impaired, but the question is how much of that impairment loss do we reverse out? Is it the full amount? Is it part of it? Because the whole idea of reversing the impairment loss is, well, first of all, you can't reverse out more than 7,800, okay? Because then that's just reversing it back to what it was before. It's reversing out the impairment. But then there's the second issue is that we can't impair it above the carrying amount either. So and you can see that from this little text box down here in the FIN notes. But what we do know is that the current carrying value at March is 40,800. Is 48,400. And we can't impair it above the 55,000. We can't impair it above the 7,800. So the difference between 55 and the 48 is actually 6,600. So of that 7,800 impairment loss, we can only actually reverse out 6,600 of it. So that's basically what we're going to reverse into our P&L. I'm going to color it yellow, so we know that it's going to the P&L. So that's the end of adjustment 5. Okay, so now what we can do is we've got all the information we need to now adjust the profit and loss. Okay, so let's start off. So we've got our draft profit and loss up here. Our net profit after tax is $32.8 million. The first adjustment is for P&L revenue. So I'm just going to link that there. Okay, second adjustment is for the P&L expense. Third adjustment, is for the provision. Next one is for OCI. Actually, that's not going to hit the P&L, that's in OCI. The next one is for reversal of impairment. Okay, so these are the amounts here. The next thing is just to make sure that I've put these around the right way. I'm just going to redo this. So I'm going to equal that. So we know that that's revenue, so that's going to increase our profit. We know that the recognition for damage is going to be expense, so that's going to reduce our profit. So we're going to go negative that. And then our this is going to be a gain, so it's going to hit our revenue on the hedging change, the ineffective portion of that. And then finally, the reversal of the impairment is going to be revenue. It's going to be debit, impairment, reversal, credit, revenue. So there we have it, 32,800. Just make sure we've got all our numbers around the right way. Alright, there we have it. We've got our adjusted net profit after tax. Okay, so that leads us to the final part, which is just plugging in our net profit up the top up here. Into our statement of other comprehensive income. And also just make sure on any report that you do that you actually include the name of the company. I haven't done it for the sake of saving time here, but just make sure you include the name of the company, Klima Limited, what it is that you're looking at. So the statement of comprehensive income for the year ended 31 March 2017. I might not always do this in my examples, but that's only to save time in these videos. But you need to remember whenever you do an exam, you need to do it because you may lose marks if you don't include these. And if you think about it, it's a 20-mark question. I don't think we haven't done, obviously, 20. It's not quite obvious where those 20 marks come from. So especially in those kinds of questions, is you don't want to leave any room on the table for lost marks. So you want to make sure your descriptions are there. You want to make sure, you know, all the nuances and the reporting style are there, because if you lose 1 or 2 marks here, these are easy marks that you can get. So just make sure you're on point when you're doing this. You want the currency in there as well that you're using. So we're doing Australian dollars. So let's put an A in there in our summary. Actually, we're doing $8. Make sure your currency conversion is the right way. If you're doing it in thousands or dollars, make sure it's the right way. So we know that that's in dollars, so I'm going to leave that as dollars up there. So, okay, so we've already got our template over here ready to go. So the things that we're going to plug in here that we took from our notes, was there a revaluation item? Well, there was a revaluation of the building. So I'm just going to change that description to building. And I'm going to link this down the bottom. So I'm going to link this in to what we had down here. So we had $1 million over here. The only question is, which way does it actually go? So let's have a look at the journal. See how this is a debit revaluation surplus, and this is credit building. So this is the one we want over here. So this one's actually going to be a debit, because we have to link into the journal. So we're going to go, so because it's a debit, it's going to be a negative as opposed to a positive. Because if you think about it, credit is income, debit is expense, you know? So it's going to be negative. Okay? Alright, moving on. We've got items that may be reclassified, and we're ignoring tax, so we can just delete this one out. Foreign currency translation. Did we have any in here? So we did have a foreign currency translation, but we only had one that hit the P&L. There wasn't any that hit the OCI, so we can delete that out. There was also no investments that were at fair value through other comprehensive income, so we can delete that as well. So the only one that we did have from here, and delete these ones out as well, is just the cash flow hedging. So whilst the element that we did look at that did hit the P&L, the ineffective portion, we have picked that up, but we haven't picked up this. So just be careful with this. The ineffective portion we need to include in here. So that actually goes through the other comprehensive income. So we want to link this in down here. I'm going to link that in 120,000. And is it debit or credit? It's credit, therefore it's going to be a plus sign because credits are income, debits are expense, and so forth. So there we have it. So we just sum them up. And the sum of our other comprehensive income is 880,000. And that means the total comprehensive income that we've got is our profit plus our other comprehensive income, so it's 963 600. And that is how you get 20 out of 20 for question 2 of the FIN117 main exam.